what we're going to be going over here is deferred tax accounting, where we're going to have a temporary and a permanent difference here, and we're also going to be dealing with an extraordinary item, which is actually going to be an extraordinary gain, and we're going to also have a change in our tax rate. So this is going to be our problem here, and we're going to look at how we make our adjustments here for tax accounting purposes here. So what we're going to be dealing with is 2 years here, year X1 here and year X2, and we're going to be looking at how we would record here year X2 for this, for our tax accounting here. Okay, so first off, we're going to have a change in our tax rate. We're going to, year X1, it's going to be 35%, year X2, 40%. Okay, so starting with, first off, we're going to be starting with our pre-tax financial income here. And I got the numbers here shown here. $290,000 here. Everything is in thousands of dollars here for year X1, and $320,000 here for year X2. But what we're going to be dealing with here, this pre-tax financial income includes an extraordinary gain of $20,000. So that's going to be this another thing we're going to be looking at here. And then next year, we're going to have a non-deductible expense here. Now, what do we mean by non-deductible expense? It wouldn't be expensed here for tax purposes here, and we got $30,000 here for each of those years, and that's going to be a permanent difference here. So that's the next third thing we're going to be looking at here, this permanent difference. So we're going to have to adjust our pre-tax income here, because the non-deductible expense was deducted here for financial purposes, but for tax purposes we can't deduct it, so we're going to have to add that $30,000 back. So adjusted pre-tax after the permanent, adjusting for the permanent difference here, adding it back, our adjusted pre-tax income will be $320,000 for year X1, $350,000 here for year X2. Now this is where we're going to come into our temporary difference here. That's the next thing we're going to be looking at here, temporary difference. Our taxable income, we're given that here for year X1 at $180,000 here, and compare it to our adjusted pre-tax income here of $320,000. So you can see our taxable income here is less than our pre-tax income. So, and the reason for that is we're going to have taken excess depreciation here for tax purposes over our book purposes. So in this case, we have actually $140,000 worth of excess depreciation here, comparing our pre-tax income. We've taken $140,000 here extra for our taxable income here. So that is simply, we can determine that here by simply taking our pre-tax income here of $320,000 less our taxable income here of $180,000 gives us $140,000. So that's what we call our originated temporary difference here for the year X1, and that's going to be a future taxable amount. It's going to be a deferred tax liability, and the reason is our taxable income here was less than our adjusted pre-tax income, and that's attributed to the extra depreciation expense we've taken for tax purposes. So we get to deduct it now, but in the future we can't. Therefore, it's going to become a future taxable amount. And then looking at our second year here, well, our adjusted pre-tax was $350,000, taxable income $225,000. So what we originated here for year X2 here for the temporary difference is the difference here is $125,000. So actually, what we're looking at here for year X1 in year X2, we have a cumulative amount here of originating temporary difference. It's accumulating over these 2 years here. Okay, so let's go down and first thing we have to do is we have to determine what our deferred tax liability is, and then we're going to be looking at the change in our deferred tax liability. Okay, so first off, for year 20X1, we started out here with what? Originating, and we're going to have zero. Let's just say there was nothing in our deferred tax liability account at the start date here, at the beginning. So all we have to deal with is what we originated, temporary difference for the year here, for $140,000. So we take that times our tax rate, and remember for year X1 here we had the tax rate here of 35%. So that's what we do here, 35% times the difference here, temporary difference here for the first year of $140,000 gives us a deferred tax liability of $49,000. And then for year X2, well, we look at the accumulated amount here. We take the $140,000 here for the first year here, plus $125,000 here in the second year. So the total amount here of cumulative temporary difference is $265,000. So we take that times the new tax rate. That was the tax rate here for year X2, 40% here. That's going 40% times $265,000 gives us a deferred tax liability of $106,000. So next we have to determine the change here in the deferred tax liability for recording this the accounting here on this problem. Okay, so let's look at it here. First off, for year X1, we start with our tax rate here, 35%. So we take the deferred tax liability at the beginning of the year here. Well, we said it was 0 here at the beginning of the year, but at the end of the year here, year X1, based on our tax rate here, 35%, that we had a deferred tax liability of $49,000. So what we need in our deferred tax liability account here, based on that 35% tax rate, is a net increase required here, $49,000, from 0 to $49,000 here. Now, this is where we have to come in. We have to make our adjustment for this new tax rate. It moved from 35% here in year X1. It's moving up to 40% here in year X2. So this is how we deal with that. We take our ending balance here. We'll look at it in end of year X1 here, $49,000, our deferred tax liability here. That was at that 35% tax rate. Then we have to recalculate it here based on the 40% tax rate. So remember, that was that $140,000 here of originated temporary difference in the first year times the new tax rate here of 40%. So that amount is going to give us $56,000. So what we would do is just take the 35% balance, our deferred tax liability at 35% here, $49,000, and then we compare it to the deferred tax liability that recalculated here at $56,000. So what we have to do is we have to have a tax rate adjustment here of $7,000 here for the year when we change to that tax rate. And that's really going to go against our year X2 taxes. Okay, so there we've taken care of our adjustment to our tax rate. Now, what we do here for the change in our deferred tax liability for year X2, all we do is, well, we carry over what the new deferred tax liability is, that recalculated amount of $56,000. That becomes our beginning year X2 deferred tax liability account here, $56,000. And then at the end of the year X2, remember, we calculated that to be $106,000. So we have to increase here from that revised tax rate here, the amount of deferred tax liability of $56,000 to $106,000. So that's going to give us a net increase we required here of $50,000. Okay, so we've taken care of our determine what our deferred tax liability is here. That was like step 1 here, and then step 2, we had to determine the change in a deferred tax liability, the change here from year X1 here to year X2, and we also had to take into account the change in our tax rate. So you see what's going on here. When you have a change in the tax rate, you have to do a recalculation here. So we originally calculated our deferred tax liability based on the tax rate here that we had for year X1, but we had increased it here for year X2, so this is the case where we had to make the different. We have to make up the difference here. What this increase, in this case, it was an increase in our tax rate, so that's going to increase our deferred tax liability, and we went through the arithmetic on that. Okay, so next, let's go and let's look at how we'd record this here. Okay, so this is what we have to deal with. We're going to have our tax payable here, and we're going to have a deferred tax liability here. And based on our tax payable, a deferred tax liability, we're going to calculate our tax expense. And tax expense goes to the income statement. So first let's look at our tax payable, and we'll just go through both year X1 and year X2 here. So what you do is we take our taxable income, that's what we had here, we had shown here for each of the years here. We take that times the tax rate. So the first year here we had a taxable income of $180,000, tax rate of 35% gives us a current tax expense or a tax payable of $63,000. So we go and credit our tax payable account here on the balance sheet here as a liability for $63,000. And then the next year it increased, our tax rate was to 40% times our taxable income of $225,000, tax payable of $90,000. So credit tax payable here $90,000. Now for our deferred tax liability, let's move over to that here. So remember, for the first year here, well, we had a 0 balance. It increased to $49,000, so we have to credit or increase our deferred tax liability by $49,000, since we had a zero balance, and that's what we had here for the year, that originating difference times the 35% tax rate. Now we have to take into effect that tax change here. Remember, we calculated that to be $7,000 due to the tax change here. So we increase our deferred tax liability by that tax change. So remember, we had to recalculate our taxes here at the end of the year here, and we were sitting at $49,000 at the 35% tax rate, but after we recalculated at the 40% tax rate, we come up to $56,000. So that is where we make up the difference. 49 here compared to 56. There we have to increase our deferred tax liability by $7,000. So we may as well move right over to our tax expense on our income statement for that case. So we had a credit or increased our deferred tax liability. That's going to increase our tax expense. We would have debited or increased our tax expense by the $7,000. Now remember, that's for the tax change from 35 to 40%. And then looking at the second year here on our deferred tax liability, we ended our balance here after that adjustment. Beginning of balance here for year X2 was $56,000 after our adjustment for our tax rate, and then the ending amount for the deferred tax liability was $106,000. So difference here, we had increased our deferred tax liability required here, credit or increase our by $50,000. So for year X2 here, the deferred tax liability is really going to be the total here, $7,000 for the tax change plus the $50,000 here in the change in our deferred tax liability. And then let's go over here and let's look at our tax expense here. So this is knowing our taxes payable, deferred tax liability. Now we can calculate our tax expense. So just going up here and looking at the first year here, I got it laid out here. So our tax payable, we had a credit here of $63,000, and then we have a credit here in a deferred tax liability here of $49,000. So $63,000 here, $49,000 here for the credits. That's going to equal our tax expense. Totaling them up here is going to be $112,000. So this is where we're going to debit our tax expense here for $112,000. So you can see tax expense just becomes a plug or a balancing amount here between our tax payable of credit here is $63,000 and our deferred tax credit here $49,000. Debit amount here, increase your tax expense by $112,000. And then for that year X2, well, remember we had that change in our tax rate here from 35 to 40%. So that increased our tax expense due to the fact that our deferred tax liability was increased. So that we would have debited here for $7,000. And then year X2, just looking at our change here in our deferred tax liability, we would have we had that credit here of $50,000 plus our tax payable, that was the $90,000 here. That was at $225,000 times the 40% tax rate, $90,000 here. So we had a credit here, $50,000, credit here of $90,000. So what we need is the balancing amount would be going into our tax expense here on income statement, $140,000. Okay, so we've recorded here our tax expense based on our tax payable and our deferred tax liability. And where we had this, remember the change in our tax change here. Since the tax rate increased from 35 to 40%, you can see it increased our deferred tax liability. If it had gone the opposite, if our tax rate would have increased or decreased, excuse me, then we would have had a change in our deferred tax liability would have been reduced, and consequently our tax expense would have been reduced. Okay, so next let's go down here and let's look at how we would report our income tax section here on the income statement for 20X2. Now this is where this extraordinary item that we talked about, that $20,000 worth of extraordinary gain, comes into play. So this is how you do it here. Again, looking at year 20X2. We start with our income before taxes and before the extraordinary item. In this case it was the extraordinary gain. And we're going to come up with $300,000. So let's go down and let's look at that here. So we had the $320,000 in pre-tax financial income. Now we would subtract out this extraordinary item. It isn't included. That's going to be be included here are reported separately down below here. So let's look at, we had that $20,000 extraordinary gain in this case. $320,000 less the $20,000 extraordinary item or extraordinary gain gives us $300,000. So that's what we're going to start out with our income before taxes and before the extraordinary item. So we have to subtract out that extraordinary item here of $300,000. Now we have our income tax expense, and we're going to be looking at, well, let's look at it here. So we start with our current amount. That's our tax payable here, the $90,000. That's our tax payable. That's the current tax expense here. But we have to subtract out this extraordinary item, the extraordinary tax here on that extraordinary item. So we'll go down and look at that. So we had the tax payable here in $90,000 here. Now the extraordinary item, let's go and look at that. So we had the $20,000 here of extraordinary gain in this case. We take it times the tax rate here for that second year here. It was in, let's say in the second, we're looking at the extraordinary gain here in the second year here, 40%. So 20,000 times 40% tax rate is going to give us $8,000 here. 20,000 times the 40% tax rate, $8,000 here. So this is where we have to subtract out from our current portion here of our income tax the $8,000. So we take, what would that be? That's really our tax payable less the extraordinary tax. Just so you understand, that's the extraordinary tax on this extraordinary item here. So net amount comes up to $82,000. Now we look at the deferred portion. Well, this is a deferred tax liability, and going up here for these first, let's look at it here. The deferred tax liability, we had that credit amount here of $50,000. That was simply the change here in a deferred tax liability, $50,000. So that we would put in here as part of our income tax expense. Then we had the tax rate adjustment. You have to break that out here for your tax rate adjustment of $7,000. So here, just remember here, you have to subtract out that extraordinary, any taxes on the extraordinary item aren't included here in our current amount for income tax expense. But then after subtracting that out, we have to include our deferred portion. Deferred tax liability increases our tax expense, and the tax rate adjustment, since it became part of the deferred tax liability because the tax rate went up, then we have to break that out here and include it as well. So summing everything up here, we're going to come up with the income tax expense here of $139,000. Okay, so now our income before the extraordinary item, we have to net everything out. We started out with the $300,000 here before the extraordinary item. The extraordinary item was not included here. Subtract out our income tax expense here before the extraordinary item here of $139,000. So our income before extraordinary item would be $161,000. Now, this is where this extraordinary gain, in this case it's an extraordinary gain, comes into effect. So extraordinary gain, that was the $20,000 here. So you have to look at it, you have to state it here as an extraordinary gain, but then this is where we're going to subtract out our income taxes here. So that was a tax rate of 40% times the gain, $20,000 gain here. That gives us our income tax here of $8,000. Subtract that here from your extraordinary gain of $20,000, you're going to come up with a net amount here of $12,000. So this is the amount of income here that we're going to have here for this extraordinary gain after the taxes are paid. So that equals $12,000, and we added that to the income before the extraordinary item here of $161,000. So our net income here is $173,000. Okay, so we've did this income tax section here in income statement is important. Just remember here, when you're dealing, and we really want to concentrate on this extraordinary item here. When you're dealing with the extraordinary item, in this case, it was extraordinary gain, so we have to pay income tax on it. That you separate it out here. You subtract it. You do not include it in your current portion here. That would be the tax payable amount. That has to be subtracted out. But you would include it down separately here when you look at the gain itself down here. This is where you would include the income tax expense. Okay. So then Remember the deferred portion, that had to also be broken out. That was in case of deferred tax liability. That increases our income tax expense. And also our tax rate adjustment. We had to include that here. So all those things here become our income tax expense. And then we break it out separately. We show our income here before the extraordinary item here. That would be like our net income here. Net income here before that extraordinary item here. Then we take and we have to look at our extraordinary, in this case, extraordinary gain itself, and we take the net amount here after paying taxes. That includes our income here, or we add that to the income that we calculated up here above. That gives us our net income. Okay, so we went over a problem here. It included a number of things here. We had an extraordinary item here, and then we had a permanent difference, a temporary difference, and then we had a tax rate change. All are important items to note here, and this is how you would deal with these type of deferred tax accounting problems.